Good morning and welcome to the CIM Dividend Income Fund Investor webinar, the first of 2026. Thank you for taking the time out of your busy schedule to be with us today or this morning for the next 45 minutes. As you may know, I'm Sandrine Reynaud. I'm the co-founder of Freedom Asset Management. We've had the pleasure of working alongside Santa Lucia Asset Management for the last 10 years, and I'm delighted to have here on the panel Florian Weidinger, bottom right, CEO and CIO of Santa Lucia, James Morton, top left, Chairman, and Ferry Haryoto, Director of Research. So just as a brief intro, 2025 was marked by the US tariffs, which surprised everyone by their pace and scale. This should have affected the markets, but despite all of the noise that we've seen in 2025, the markets performed very well, and the fund in particular was up 28%. We were also delighted to see that the AUM raised to 1 billion. So I'd like to thank all of our investors for their support and trust during that period. Now, on to the remark from our speakers. So today we'll start with Florian, which will be giving us a view on the outlook for the region, as well as the portfolio changes, and then his recent trips to China, Thailand, and he's today in Kazakhstan. It'll be followed by Ferry. Ferry will be commenting on Indonesia. He'll have the pleasure of talking about what's happening at the moment. And then followed by James commenting more on the FX and the Chinese property market. Then Florian will come back to do a quick wrap up before we go into the Q&A session. So if you have any questions during the presentation, feel free to include them in the Q&A box. We'll pick them up at the end. I'm sure we have a lot to cover, as usual. So Florian, over to you.
Thank you very much, Sandrine. And a happy Lunar New Year of the horse to everyone. 2025 was the year of the snake, and all of us had to wiggle through and dodge some bullets in geopolitics and headlines, as Sandrine alluded to. And I'm pleased to share with you that 2025 was a good year for the strategy. And in spite of global events, but also a shift to a more growth and technology-led market here in Asia, which is typically not the most conducive environment for our value and dividend strategy, the strategy actually managed to perform and celebrate also a few successes, in particular in areas where positions that the fund had positioned in and where we were either hoping or suspecting, sometimes collaborating to create a catalyst. Some of those have positively come through last year, and the portfolio also managed to avoid a lot of the downsides during some of the market dislocation. We had one security, that's China State Construction International, that detracted about 70 basis points from performance. And other than that, no other security deducted more than 50 basis points from performance. The standout sort of contributors came mostly from China and Korea in this last year. China and Korea combined were responsible for over 2/3 of P&L. Our detractors were found from Vietnam, Thailand, and Taiwan. And in terms of from a single stock point of view, we have to single out China Hongqiao, which was a strong winner already last year, and is actually a nice example that even in the strategy that is very tethered into risk reward, thinking of the margin of safety, and therefore sometimes runs the risk of not letting winners run through sort of continued re-underwriting of new realities and fundamentals and dividends. We've been able to hold Hongqiao through all this time in the strategy, and it contributed. The other major contributors were Wasion, which we also had in the portfolio for a few years, Chinese smart meter and grid company. Our engagements in Korea on the value up with, in particular, NH and JB, And then the fifth largest contributor was the leading Kazakh bank, Halyk, whose CFO I saw a few hours ago here in Almaty. All these companies have in common that the SLAM team managed to run a strong and frequent relationship with key individuals at the management or shareholder layer of these companies and help to both understand them from a research point of view and sometimes also nudge the company into doing the right thing. The looking into 2026, we're not really changing much of what we're doing. We're doing the same thing we have been doing in 2025, but of course, the turn of the year is always a moment to take stock. And I'm going to borrow a bit from our December letter here. Other than the big one, which is currency, which James will be focusing on later in his segment, some of the questions we're asking ourselves as we're entering this year, which of these trends could continue, which of these trends do we need to watch? A big one has been the success of China's exports. China's exports contributed around 150 basis points to GDP growth last year. That surprised most analysts who expected something different in a trade war year. It probably surprised Beijing too. That was certainly our impression from our most recent visit 2 weeks ago. The Chinese export engine is now running at $1.2 trillion. Can China continue to navigate the geopolitics, but also the domestic politics in some of its target countries for its exports? As it stands, China's relationship with other EM countries, the Global South, and that's evident again right here. The Belt Road Initiative rose over 75% in funding to over $200 billion. We see a lot of portfolio companies that are expecting 2026 to be another strong year. Zoomlion, for example, who we saw recently in Shanghai, they are expecting 20% growth for their overseas business. So they make construction machinery, work platforms. They are expecting 20% growth in their overseas business. In their case, underpinned by over 5,000 employees outside of China. So they have support and maintenance and service networks in all their end markets. So that's an example of a Chinese export that's likely well defended. I think in particular, Korean and Japanese competitors will need to continue to watch out, but also Europeans for the continued strong level of competition coming in the industrial sectors now from China. The other question is can the technology cycle in the Asian supply chain, which has started to perform quite strongly, but is associated a bit with the US tech sector, and we're seeing Magnificent Seven have started to sort of lag the S&P 500 or the S&P, the S&P 493. At what point do sort of mainstream Asian equities become exposed to capital market shifts in the US? We are not exposed much in this portfolio, but the broader market is. And to give you some perspective, right, the top four names in the MSCI Asia Pac ex Japan, TSMC, Samsung, Tencent, Alibaba, all relatively highly valued and not eligible for our strategy based on their dividend yield. Those four companies are 23% of the market. So that's 10 trillion of index market cap, and roughly almost 2.5 trillion is those four companies where investors are chasing the Asian tech supply chain into the data center build. And so US vulnerabilities could build into Asian mainstream equities, and that's sort of a question mark we all need to follow. Chinese stock market sentiment remains strong and also a bit akin to the US now on a retail level, driven by a bit of euphoria. IPOs in Hong Kong are increasingly tethered to technologies, to loss-making companies, and that are finding it an appropriate window to go public. And then the third question we're asking ourselves is whether the rebalance of the Chinese economy towards consumption is, which is something investors seem to be waiting for and looking at it every annual outlook in January, whether that shift is finally occurring in China in the terms of many broker notes. In share price terms, the consumer sector has not been a good sector for the market last year. In fact, it was an underperformer. There were a few companies that have done well. In particular, those companies that were selling into the trade-in program. So China had this program where subsidies were given to consumers who were buying washing machines, computing equipment, sort of larger household items. Those subsidies drove, in the estimation of economists, around 40% of the retail growth portion in China last year. And these subsidies are coming back at roughly the same order of magnitude, but probably slightly below. So there's a question mark as to how that segment of Chinese consumption can do when sort of the boost from the subsidies is maybe not quite the same as last year, and also how many washing machines does one really need? So if there's consumer growth in China, we have to look at other segments as well. That's a question we're asking ourselves. We have recently bought more shares in what is probably our favorite China consumer name, which is a company called Bosideng, which makes winter coats. We we are seeing quite a lot of evidence that Beijing is very aware of this, not so much the Wall Street expectation of what consumption does, but really that this is a core question for managing the economy and what to do for households, what to do for families with children. The leadership is really focusing on this, and every think tank that we have seen 2 weeks ago was reporting that the officials that they meet are definitely focused on this. They may not find the right answers, but they're definitely focused on it. In terms of the portfolio, what have we been doing maybe differently more recently? There have been some changes throughout last year. The Korea weight has come down a little bit, simply on a realization of risk reward. And actually, this January, our Korea percentage will be decreasing further as we sold most of our shares in Kia Motors, which was a top 10 holding. It was actually a Liberation Day buy for the fund. And on our first purchases, the shares are up 100%, and it's up over 50% on our cost base. This month, they're up around 40%, as some of the technology enthusiasm got reflected in those shares because both Hyundai, the sister company, and Kia have some exposure to robotics, which in fundamental terms is actually not that significant. So we've taken the opportunity to exercise our selling discipline based on dividend yield and earnings, and have been significantly reducing our Kia portion. We still like the Korean opportunity from a research point of view, but it is also fair to say that many names in that market are starting to price outside what we like as deep value. But we are still looking at new ideas in Korea, and we might be adding one new one later this month. In fact, we added one more new one just towards the end of last year. The other changes, we have been buying a little bit more of the Chinese consumer names that have had their share prices decline and where people were disappointed. A lot of those people positioned into this at the beginning of last year didn't quite come through other than for those trade-in programs. So that has been an area where we could pick up a few percentages, and we have been tilting a bit more towards Southeast Asia, Thailand, and Indonesia. You have heard Hannah talk about Thailand here on the last call. One of the names, Krung Thai Card, is now in the top 10, and we're working here with the board and management to hopefully convince them to do more for shareholders. Our letter has been received and discussed, and we await the board's decision on an update to the capital management program. Thailand remains a very unloved market by most investors. Our property companies have started to perform, and I'll be there just before the election next week. Before handing over to Ferry to talk a bit more about Indonesia, I just wanted to give a very quick share of impressions here in Kazakhstan. I'm in Almaty today, and I was in Astana yesterday. It's a country where we've made good money in, mostly through our Halyk Bank holding, also in the top 10. But also a country that has become increasingly relevant for a lot of Chinese firms, and that's why we're taking a more expanded research interest in it. Kazakhstan is very much at the forefront of Chinese firms expanding into Central Asia. It has also managed, ever since President Tokayev came to power in 2022, it managed to really create more equidistant positioning as a country away from Russia and closer to China, also closer to the West. China has actually overtaken Russia as Kazakhstan's top trading partner. Total trade actually of China with all the 5 Central Asian countries is now over $100 billion, and it's a very obvious sort of Belt and Road beneficiary. Well, it is also the historical Silk Road, so one shouldn't be surprised. And the importance of the president can't be underplayed. I met one of his advisors yesterday. He's a fluent Russian, English, and Chinese speaker, so it's very rare for a leader in this region to be able to speak to both Xi and Putin without translators, and with the U.S. president. In fact, the Central Asian heads of state were all in Washington, D.C. in October or November last year. So the country has managed to really maintain equidistance. There are Kazakh companies that get special dispensation for the U.S. State Department to legalize their essential trade with Russia. So this outreach also includes not just the 3 big powers. It also includes countries like Korea. You have a lot of Korean presence here. In fact, Kia, our portfolio holding, has made its biggest investment outside Korea and the US here in Kazakhstan. The government has made significant progress in moving away from sort of the historic authoritarian model to a more institution-led model. There's a Supreme Court, there's municipal level politics now, democracy. Last but not least, it's a resource economy. The budget is about 10% of GDP is a budget contribution from commodities, which makes this a relatively wealthy country in the region, $15,000 nominal. That's about similar sort of order of magnitude to Mexico in GDP per person. But valuations are cheap. Halleck is paying us a 13% dividend yield and is trading at less than 4 times PE on near 30% return on equity. No one can quite project the future, but one thing that's possibly in store is continued interest rate cuts from a high here to defend the tenge. The tenge is actually now appreciated against the dollar. And from here, there's a plausible rate reduction path, which would be positive for bank earnings here, similar to what we've seen in Pakistan in the portfolio over the last few years, coming from a relatively high inflation and rate environment and going lower. With that, I will finish my report and hand over to Ferry to talk a bit more about Indonesia, which has also been in the news of late.
Right. Thank you, Florian. So yes, everyone should be well aware by now. This has been top news in Bloomberg, obviously. As you know, the MSCI has paused the changes or the rebalancing of the Indonesian component in their index. They have demanded greater free float transparency to determine the actual free float of companies that has made the MSCI inclusion, as well as those that are candidates for the inclusion. So what they are asking for are the ultimate beneficiary owner of company nominees, which often hides, or often disguises itself as actual free float, while actually is affiliated with the sponsors. So the MSCI has given the IDX until May before their next assessment. They have basically warned the Indonesian authority that they may demote the market from EM status to the frontier status if we have not met their demands in a satisfying way. And of course, what that means is that the worst case scenario risk is a 10 to 11 billion outflow. So basically, that sent the market into panic mode yesterday, and we saw a major sell-off yesterday and into the first session of today's market. And today the market's down by as much as 9%, but intraday was as low as about 15%. There had been somewhat of a recovery in the second session, as basically the authority went out to say that they're going to solve this whole issue with the MSCI as early as March. They will take immediate actions with regard to disclosing the UBO, or ultimate beneficiary of owners of companies with stake of above 5%, and in the medium term, stakes below 5% as well. And they also have pledged to the MSCI that they will improve liquidity of the overall market, and this will be a task that is going to be taken by the newly established sovereign wealth fund of Indonesia. So the good news is, while the market is down by about 9% yesterday and today, three of our four larger holdings in Indonesia are already down by an average of about 2%. So the strategy is proving true for us, and we think what's happening in the market will eventually create a benefit to us. But first of all, why is this happening to Indonesia? So just a refresher, the Indonesian market last year basically rose by about 21%. But if we look at the LQ45 index, which is the index for the most liquid, 45 companies, most liquid and largest companies in Indonesia, it only went up by about 2%, right? So a lot of the recent gains have been driven by companies outside this group. And that rally has been driven by a small group of companies where the free float is tightly held by the sponsors, which has been actively managing the share price with, of course, the goal of MSCI inclusions. So in many cases, the fundamentals do not justify the valuation, and yet the share prices have surged hundreds of percent. And these are fueled, of course, by a new generation of retail investors. Retail investors now accounting for about 40 to 50% of the average daily turnover of the market. And they're largely driven by momentum trading and, of course, FOMO as well. But actually, the market has been performing relatively lackluster since 2024. And the foreign funds have been on the outflows last year, out by about $1.1 billion, and basically reversing the inflows in FY24. So foreign ownership in the last 5 years in Indonesian equities actually has come down to about 18% from 28%. And so similarly, the local equity fund AUM today has actually halved the peak of 2021. So today is about 70 trillion rupiah versus the peak of 140 trillion in 2021. And domestic institutional ownership has basically reflect this, now down to only 5% versus 15% in 2021. And the flip side of that, the retail investors' ownership in Indonesian equity has gone up from 5% to 15%. So as a result, right now what we have in the market is we have these companies which are trading at multiples of hundreds of times. They are becoming the new market drivers, the main index drivers. On the other hand, there are still many companies with solid fundamentals trading at single-digit PEs. And as I said before, we think that the authority will do their utmost to meet the MSCI demand. And we think this would correct the market dislocation or the imbalance. And this is the much needed catalyst for change that I believe should, in the medium term to long term, draw back attention or interest in actually proper investing. And this basically for us create interesting positioning and opportunities, because value has been emerging for quite some time. And we see performance shifting from this punting stocks to more fundamental stocks over time. And this should benefit us. Already, we are seeing many companies, given the relatively slower economy, allocating more free cash flow for dividends. And we are finding companies with yields of above 6%. So in this context, I'd like to talk about one of our holdings, Akra. This is an Indonesian fund that has been actually relatively more defensive on a year-to-date basis. The stock currently yields about 8.2%, with dividends expected to continue growing. The company is making growth investments to ensure that it can grow, but at the same time, it has been ensuring that it has sufficient financial capacity to not only maintain dividend, but also growing that dividends. So we have a company with strong balance sheet, and more importantly, the alignment of interest with the controlling shareholder. It is also, as you know, it is the largest Indonesian private chemical and fuel distributor. So we are seeing last year a momentum recovering in terms of volume being delivered. And with that, of course, improvement in profit margins. So this momentum remains very much intact, and we expect this to continue. Further improvement should also come from the retail pump station business, given that they have actually reached the scale sufficient to turn around this business from loss-making in the last couple of years to actually turning profit for the first time in FY26. The other part of the business, Accra or AKRA, is also a major developer and operator of one of Indonesia's most integrated industrial estates. So, these guys deliver about 90 to 100 hectares of land annually. And recently, it sold 40 hectares to a major Chinese chemical producer, whom I believe Florian met in his recent visit. So we expect another 80 hectares in FY26 after 40 hectares last year, with options of about 100 hectares thereafter. So this deal doesn't only boost the upside on the land sales pipeline, but in terms of utilities income, which is also recurring, this should be very sizable in the coming years. And this is something that I believe can underpin the re-rating in valuation multiples. And of course, it also contributes to the dividend growth. So yes, in summary, we think the MSCI's warning ultimately should restore advantage to fundamentally strong companies with attractive value, and of course, proper investors like us. Definitely, it should create more opportunities for us. So yeah, thank you, and I pass on the floor to James.
Thank you, Ferry. Yes, I'll just say one more thing in there. I mean, I agree with Ferry's assessment. The Indonesians will work hard to avoid the worst case scenario here. And I think this could actually end up being a really good thing for the Indonesian stock exchange and its attractiveness to foreign investors over the next year or two. Just a little quick history. We made a lot of money in Indonesia, partly thanks to Ferry, in 2004 through 2007, at which point Ferry joined the company. But a trouble for that, success breeds its own problems, which is we have to sell the shares because they no longer are the values or generating the dividends we want. And we've been very pleased to be able to get back in last year, in particular, starting to position in this environment where, as Ferry said, that the spivvy stocks have been doing all sorts of strange things, but the good stocks have been neglected, and that suits us just fine. That's an environment which gives us opportunities. And just to reinforce one more thing Ferry said, our stocks have performed very well in the last couple of days. The market's down 8.5 roughly, I think, over the 2 days. And for example, the position we've held for the longest period of time in the portfolio, CIM Niaga, which is the listed subsidiary of leading Malaysian bank, that stock price is the same today as it was before all this news hit the wire. So very, very nicely defensive. Now, turning to China, this year is full of exciting news. And my goodness, I feel like we've had almost a year's worth of news in 1 month. I'll just deal with the Chinese property market quickly because I want to spend a bit more time talking about FX. Today, word came that the 3 red lines, which was the thing that triggered the property turnaround and ultimately crash, really, has been officially abandoned. Now, I mean, this is not really news, although Chinese property stocks, many of them are up 10% today. It's not really news. We've known about this for years because essentially the 3 red lines were abandoned somewhere around 2 to 3 years ago in the way they were actually implemented. But this is official. Xi's government never likes to admit it makes mistakes. It just goes silent on the subject. So the fact that it's been admitted is interesting, but not really particularly relevant. I mean, in terms of the Chinese property market, it's still important, which is why, although we are essentially really only invested in property management services now, and yet At one point, Chinese property was our largest single country sector exposure in the fund, but today it's essentially zero. This is not a signal that things are about to turn around. The property market in China was at its peak about 15% of GDP. It's now probably more like 11.5 and heading towards 10, I would suspect. Prices are still coming down. It's more obvious in the second-hand market. The primary market is still a managed market. In terms of price declines, in the second-hand market, it's probably somewhere between 20 to 30% from the peak. There's still an enormous amount of inventory in large parts of China, particularly tier 3, tier 4, and more remote areas. So there are a few places where the Chinese property market is robust, are really in one or two of the tier 1 cities, but everywhere else, I think the forecast for this year has to be further decline, both in terms of activity and valuation. And really, we shouldn't expect too much because the authorities have limited things that they can do here. We've already got mortgage rates close to record lows, just a little bit over 3%. With a first-time mortgage, you only have to put 15% deposit down. So, you can't make it much more attractive, although bearing in mind, of course, that China is essentially in a deflationary environment, unlike much of the rest of the world. That's a real interest rate. And there is still a negative spread between rental yields and ownership costs of property. So the rental market is beginning to show a bit of sign of life. The second-hand market is now more active than the primary. This is, I think, a scenario which does not attract us to enter in any way this year, although things can change quickly in China. But the bottom is getting closer in terms of a turnaround. And the one big plus, there's a big plus and a big minus out of all this in terms of the overall financial picture in China. The minus is, people feel less wealthy because property historically has been their largest single element of their wealth. And therefore, they're less inclined to spend, and savings have been rising significantly. On the other hand, the other side of this coin is that nobody wants to invest in property anymore. So property really is now reached the point of Mr. Xi's objective, which is property is for living only, not speculation. And in fact, on the poll that we follow of investment intentions from Chinese investors, property is now the bottom intention of all asset classes, down at 2%, the record low since the poll has been created. But this means the stock market, which is of course what we're much more interested in, has been going up, and it is second only to gold now as an investment intention. And as Florian mentioned in the beginning, we are seeing more Chinese investor money coming in to the market, both domestic and in the H shares. Now, let me turn to FX. Because this could be a quite interesting topic, particularly as it relates to China. One shouldn't get too focused on FX. Just to give you an interesting statistic, I believe last night the pound-dollar FX rate closed at roughly 138, thereabouts. So when we started our first fund, in April 1994, so nearly 32 years ago, the pound-dollar rate was 141. Now, obviously, it's moved around quite a bit since then, but it strikes me as quite remarkable that 32 years later, the exchange rate is essentially the same. Having said that, what is really interesting to us today and has potentially quite a big impact on the portfolio's performance is what's happening at the renminbi. We all know the renminbi is a managed currency and it's not freely convertible. That said, the Chinese government manage it in a way against a basket of currencies that has created a serious amount of distortion in the sort of, if you will, real equivalent value. Now, the renminbi has been strengthening for the last approximately 7 months. It's up about 6% from its low last year when measured against the dollar, which is the most important currency for a number of reasons for us, as well as for world trade. But of course, the Hong Kong dollar, as you know, is pegged against the US dollar. And the US dollar is still the most important single currency for Chinese exports, even if the US as a market is becoming less important in terms of the percentage. So what is the likely trend? Well, the Chinese government, as you know, do a daily setting. The market does its own setting, which can be a little bit different. But all but 3 days since the end of November last year has seen a gradual tick up in the way the renminbi has appreciated against the US dollar. So this shows, I think, that the Chinese government is willing to accept a stronger renminbi, and they should, because, as I mentioned earlier, China is actually in a deflationary environment still, and although that may get a little less pronounced relative to the rest of the world, which is an inflationary environment, the currency should be stronger. And we think that they will continue to allow this, but in a very slow creep. So, you know, we've had one level, we've had one bank estimate that the fair value of the renminbi today is more like 550 as opposed to 695. And quite a lot of commentators believe if this was a freely traded currency, it would be 6 or less. So I think we will see a very gradual appreciation. Now, this has some significant impacts for us potentially. Companies, obviously, that we're looking at, those who are exporting from a Chinese manufacturing base, their cost structure will rise a little bit, but it doesn't seem to us that it's enough to make a big difference. It does mean that overseas earnings will be somewhat lower when reported back into renminbi, but that is, as Florian mentioned, is not by any means the bigger part of our exposure. I mean, we are mostly in stocks which are domestically focused, and some of them have essentially 100% of their revenues and indeed profits and cash flow in renminbi. So we are expecting that this could actually have a material impact on performance, because most of our companies are listed in Hong Kong, which, as I mentioned earlier, is pegged to the US dollar. So this means that on translation, earnings and the strength of the balance sheets should be somewhat more than they are actually in the underlying earnings and asset growth in the domestic currency. So we expect to get a little bit of a bounce out of this, not so much based on the 2025 year end, but notably in the first half of this year, because the like-for-like measurement will be much greater in the results sort of reported for the June period, the half year, than they are for the year end of last year. So we think this means that the growth, when we tell you we see earnings growth of X and dividend growth of Y for our portfolio, given that about 40% of it is domestic China currency, we actually think that the growth we will end up reporting is a bit higher than that. And I think this is an important trend. And you can see that this is not just a Chinese issue. It's clearly had a very big impact on other currencies, particularly Korean won and Japanese yen. The Japanese yen, I would argue, has been managed until this week anyway, has been managed downwards specifically with the Chinese market in mind, and the distortions that this managed currency environment has created means that the yen has been way too low against the US dollar, and indeed generally against other currencies, and the Korean won to a lesser extent, but the direction has been the same. It has been to some extent suppressed because of the competition with an artificially depressed renminbi. And so we would expect, I mean, as Florian said, Korea is not as important to us today, as it was 12 and 18 months ago, and Japan is of marginal interest. But I think you could actually generalize this more or less all around the region to a greater or lesser extent. So we expect to get in this year a little bit of a benefit from currency, which is not normally the case. And so that's something we shall look forward to reporting in the year ahead. And with that, I will hand back to Florian.
Yeah, thank you, James. And as James hinted, we try to not become too involved with the macro, but the macro is sometimes important to understand the context of where we operate in. But of course, we're focusing very much on our single securities. And one thing that I wanted to also share in that context is where does our portfolio stand? James mentioned earnings growth and valuations. We are at the moment looking at about 6.9% earnings growth, which is actually interesting factoid, is actually slightly higher than the 40-year long-run S&P earnings growth rate of 6.7%. But in this strategy, you're also getting a nice dividend yield, which is around 6.7%, and in any case, hopefully higher than the 6% target, which we have met over the last 25 years. And our exposures are domestic. We have less than 3% in aggregate revenue exposure to the United States. And even within, for example, China, we are tilted more towards domestic and RMB earnings. So while of course on a PE range we are at around 8 times right now, we were at 5 at the bottom of the market in October 2022, and our range has been between sort of 5 and 11 historically. We are compared to most other asset classes that are sort of out there, which seem to be towards their top decile or even top percentile of their fundamental attractiveness. This portfolio and this strategy is certainly not at the top end of its historical range. It is not at the bottom anymore, but it's more in the medium of the range. In a broader market that is in the top percentiles, we are also continuing to see a significant flow of ideas. One of the famous quotes of Peter Kandel is that there is always something to do, regardless of the environment. And we are in the obvious places: Hong Kong, China, India, Korea at the moment, but we also are looking at Thailand and right here, Central Asia. So despite all the headlines, the flow of research ideas that meet our investment criteria continues to be strong, and new ideas get introduced to the portfolio quite regularly through the Valiant Dividend Compass. And maybe Ferry's segment also highlighted 2 other important points. One, the sort of typical capture ratio of the portfolio is quite favorable, with a historic between sort of 85 and 100% upside capture, but also only around a 50% downside capture. And our Indonesian last few days have shown that again. And as also illustrated by that comment from Ferry, the vast majority of the shares that we own tend to be away from the so-called mainstream, and therefore are less held by others who may be experiencing pain in their mainstream equities book when it occurs. So we see the opportunity set as a continued flow of good ideas, and where we are from a fundamental point of view, we believe we are at a very different moment of the distribution than some other global asset classes. And that's, of course, where we have come from. Asia is coming from a very different place, and Asia is the home to actually relatively solid monetary and fiscal policy by comparison. And that's another important context to the currency point, that as you see dollar weakness, a lot of Asian markets are actually offering very attractive fundamentals on their currency and even on their fiscal and monetary management, compared to a few other corners of the global allocation menu. And so with that, I'll hand it back to Sandrine for Q&A.
Thank you very much. I think we have few questions which are specifically on Indonesia. I feel like we have covered quite a lot of it, but just to be very clear, if one of you could pick up on, it's very specific on the effect of the situation in Indonesia on the portfolio, and as you look at those positions, are you holding, buying, or selling? I think we've covered some of it, but just to summarize.
Yeah, as a very quick answer, and Ferry can add some more of the context. We have put out buy orders in this environment today. We are so far the portfolio has fared well in this period. These changes and these headlines do not really affect the fundamentals of our companies. And as Ferry pointed out, what is happening is essentially a targeting of the speculative stocks that have been trying to manipulate their way into MSCI inclusion, and MSCI is putting the foot down and is also signaling to Indonesia, get your act together. We believe this is a strong enough warning for Indonesia to get its act together, as all the actors involved would like to avoid global embarrassment. I'll let Ferry add a bit more nuance, but yes, we are marginally buying here, and it doesn't really affect the fundamentals of our shares.
Yeah, thank you, Florian. So I'll just add a little bit to that. As I was saying, the institutional position in Indonesia, both locals and foreigners, are already very low. So with the authority doing their utmost to correct this imbalance, and as I said, in the medium term, this should draw back the interest in proper investing by local investors, which have been drawn to some of the speculative stocks. So I mean, there's opportunities now that for a re-rating on some of these names that have been ignored. And I think, some of the foreign funds and of course the local funds will follow suit, will come back to some of these names. And that is something that I expect to happen, not waiting until the authority meet the demand of the MSCI, but that's already in the process of being pricing in, starting, I suppose, already starting in this recent market rebound. Yeah.
Thank you.
Thanks.
So another question just come up, which is interesting. So it's on Chinese bank. What is the biggest risk today in investing in Chinese bank, and how do you protect from the downside in these investments? I don't know, you have a strong view.
We always have strong views, but we also always update our strong views depending on new circumstances. Yeah, at the moment, we're not invested in Chinese banks at all. We're invested in lots of different industries in China, but we're not invested in the banking sector. Now, the banks have had a good run in part because the government wanted their share prices to go up a little bit for the recapitalizations, and the insurance firms have been buying a lot of banks. That arithmetic is getting a bit more challenging, as there's a limit to how much banks insurance companies can buy and how much of a single bank or single insurance company can buy. And we've already seen evidence that the insurance firms are broadening their buying interest in Chinese equities beyond the banks. Somewhat curiously, they have broadened it to buy each other, which if I was the insurance regulator, I would be very interested in, but that's a separate topic. But we're seeing evidence that the sort of the big trade of Chinese insurance buying lots of Chinese bank equities there, that there's a ceiling to that. And then of course, Chinese banks are ultimately a policy tool, and as a public shareholder, as a minority, you need to be cognizant of that. And so while we are very comfortable investing in state-owned companies in China, where we think incentives are more frequently aligned than one would think, for reasons like share option plans, the orientation for shareholder value creation, buybacks, dividends, and so on. In the case of the banks, that dial might be tilting a bit the other way if in doubt. And so that's why we have been sitting out the Chinese banks here. But we are comfortable in taking other types of risk in China.
Thank you. The next one is on Korea and the Value Up program. And somebody who's following the fund very closely was saying that you decreased your position in Korea from 10% in 2024 to 6% in 2025. You're struggling to find opportunities, or so I think that the question is around what the reason of the decrease.
Well, actually, we went all the way to 15-16% of the portfolio in Korea during 2025, and so we at one point found a lot to do in Korea, but not only a lot to do, it also was from a risk reward point wise to put a lot of money into what we found. We continue to find interesting situations in Korea, but the risk reward is not quite the same as it was 3 years ago. And you will recall that we have been arguably one of the very early investors into Value Up, even before Value Up existed. And so as so often in these trades, as they become more popularized, you get a bit of a reward in share price terms, but also the risk reward into positioning into them declines. And so our position on Korea is purely a reflection of the changed risk reward. I think we've been 3 times in the last 12 months to Korea, and we added a new position just at the end of last year. So we are continuing to find things. But yes, you're right in your sort of hint here that it is getting harder to find slam dunks in now that everybody has heard of Korea Value Up. People are obviously positioning ahead and so on. And so what is available on our investment menu, and remember, we are a very deep value investor, is naturally more restricted, but we're still finding new ideas there even today.
Thank you. And then maybe a final question before we close. On last year, there was in several of the letters, you were talking about how the central government, Chinese leadership was supporting the equity market. Are you seeing similar thing? I mean, I think you touched on a little bit, but any other support for the equity market?
I can start, and maybe James can add a few points as well. I mean, this remains our understanding. We believe that the July 23 Politburo was the starting shot for the equity market matters to Beijing. I think it's important. The equity market to Beijing doesn't mean it's a one-way trade, and regulators are definitely keen on what they call a slow bull market in China, which is sort of a term that people throw out over here. And simply because they have been very burned by the experience in 2015. So they don't want runaway speculation in the stock market. You will have seen that on the day when volume peaked in early January and when the WeChat search index for A shares peaked, that's when the government reminded everyone of margin requirements. And it was just that comment that then sort of pulled speculative elements back. Margin balances are not a big problem, actually. We're running at peak absolute, so 2.5 trillion RMB, but in relative terms to the market cap, because the market cap has gone up as share prices have gone up, that ratio is actually at below 3%. So, which is roughly the long run number. So there's no evidence that margin lending is a problem today, but nevertheless, Beijing felt it opportune to drop a hint to cool people down a bit and remind people it's not a one-way street. And also, we had national team selling this month. You had over $50 billion of national team selling. In order of magnitude, that's roughly similar to the national team buying actually now 2 years ago, in early 2020, in the first half of the early 24 interventions. So Beijing is sort of very carefully engineering the slow bull market. The real objective is to create equity value and savings for people. It's an important part of a wealth effect alongside property. And you've probably seen us write a lot about and say on these calls here, make references to the sort of household deposits that could get interested in buying more of the stock market. Beijing is not standing in the way. On the contrary, Beijing is in part fanning this a bit as well here. So we are seeing evidence of some of the. So while 90% of deposits continue to get rolled, there is a small number of deposits that are now getting put to work into gold and into the stock market. And so we are seeing more marginal buying, but Beijing is carefully managing this aspect.
Yeah, I think that's the thing. Careful. I mean, as Florian said, the 2015-16 experience is one which they are still referring to as something they do not want to see happening again. But equally, the support for equity markets, which frankly has been completely missing pretty much since 2016 up until a year or so ago, a little bit longer. There is definitely a different attitude today amongst all officials at every level. And so Yes, and it is, I think, linked to this point. Property, as I said, used to be and still is, I think, unfortunately, the single biggest investment area for people's savings. But it's not where people want to put new money, and it's not constructive to the health of the Chinese economy. So we have seen plenty of comments from both officials in various departments, as well as those directly related with the stock markets, that they are happy to see more money flowing in. And we have seen a gradual increase over the last 18 months in the expectations of the individual investor panel to put money to work in the stocks, and that is showing up in the flows and also in the numbers of new accounts that have been opened as well. I think, although this is a little harder to track, reactivation of dormant accounts. And of course, the Connect program has seen additional companies included and some relaxation of the way it's operated, which is good for Hong Kong, which is where we're still primarily invested, although we do have some domestic holdings. So overall, we are expecting a supportive and constructive environment in terms of the official line, and Chinese investors are very, very sensitive to the official line. And we expect that to continue. Certainly in the foreseeable future, which the foreseeable future today is not as easy as it used to be, but I would anticipate this year being another year of constructive support from the authorities for the development of the Chinese stock market. And they are, as Florian mentioned, keen, I think, to see more funding in equity through the IPO market. That has been a market which has been very quiet. Now, not all the companies coming to market are ones that we would want. In fact, I would say I don't think we've seen a single IPO that we would want to invest in. But that's fine, because it builds overall interest and liquidity, and there is still an enormous amount of money. I mean, the level of savings in China continues every month to hit a new high, in spite of some of the money finally now finding its way into the stock market. And so I think this will be helpful for us in the year ahead.
Thank you all. I'd like to take the opportunity to thank all of the speakers and everybody attending. We have no more questions, and we have now filled our hour. So I'm wishing everybody a great rest of the day, and thank you again for attending.